Well, we have an action-packed program today, so I do want to get started very early so that we can cover, there's a lot of material going on. Welcome to the LIAFPN. Thank you for your loyal memberships. For those that you are members, for new members, if you'd like to become a member, liafpn.org. There's a membership form. We vet all the people that we work with. Everybody that attends these or who's involved with the LIAFPN is a trusted professional, and we do introductions and try and make this thing great. We are now talking about doing some live events, finally, maybe May or June. We're open for suggestions. This is a membership organization. It would be nice to see everybody again, even on a limited basis. We're gonna continue this format for a while, as it has been very productive. So with getting started, today's presentation is going to be about all the tax changes and everything going on, where the opportunities are, and why it's so important to plan today more now than ever. So I'm going to share my screen here. See if we can't.
And remember, these are all proposed.
You got it. So everybody see my screen? Is it okay?
Beautiful.
Okay. So today's presentation is going to be 2021 tax proposals and planning opportunities. Now, some of these things in New York State have already taken effect. There's a lot of things on the board, so we want to move forward. First off, in the life insurance world, there's major changes going on. For those that you know or don't know, IRC Section 7702 is to change the fixed interest rate assumptions on current rates. Basically, the impact is 7702. It's allowing for a lot more cash to come into life policies without being a MEC. They did this because of the extremely low interest rates. Last week, and this is why this seminar is current, Regulation 187, a very onerous regulation that started about 2 years ago, was overturned in the Supreme Court and deemed unconstitutional. Big deal in the life world and annuity world, fixed annuity world, in only the state of New York. Regulation 49A, which is another regulation affecting the life insurance world. Starting this year, regulated index life insurance proposals, particularly when it came to bonuses and other things, what was happening with, mostly outside New York, some of these egregious contracts were showing huge bonuses and everything else in the illustrated rates, and they weren't performing to the way they promised, particularly because what had happened is they would show in these great rates and these great performances, but if you had a down year, they didn't show that there was a cost to all that. So without showing that cost, didn't perform as it did. So what it's done is it's kind of leveled the playing field. But all these products are changing because of this 49A and 7702, and 187 is going to affect New York. Long-term care, I did want to bring this up. On the brokerage side of the world, we're down to one remaining standalone carrier, and I've confirmed with that carrier, they've already filed for price increases in the state of New York. So if you're on the fence and thinking about long-term care, or your clients are thinking about long-term care, it will never be cheaper than it is today. Is it going to change? Yes, a lot of the business is going to hybrid policies, but there's one on the brokerage side, standalone. There are a couple career companies that still have a long-term care product. But again, when you're the last remaining product, you can raise prices, and they're limiting on dementia or family history of dementia, getting policies or rating policies, and they're being much more selective in their process.
Just to point out, from my experience, I've seen clients coming in with older policies that were fixed term, fixed. You're going to pay this amount every month. Well, they've gone up. They filed for the protection under New York State Insurance Department, and they've gotten raises in cost, sometimes as much as 150%.
Right, absolutely. So you need to review those policies, and some of them you can have reduced paid up, or do some different things with. So it's always good to review when somebody has a price increase. Let's review what your, policy looks like today and see if we can't alter it to keep the price stable or keep it, if you need it. So, so the proposed tax change, I'm going to ask my friend Lawrence Scherer, state attorney, to go over the updates, proposals, and many of these occurred last week. So I'll let you take away the Washington update.
Okay, so the federal exemption is going down. It's just a matter of when. The current law, we were expecting on last Wednesday when the plan came out that they were going to propose a $3.5 million exemption per individual, and we were unsure whether or not there was going to be any portability remaining. What ended up happening is the new proposal did not have a change in the estate exemption amount, which means that the phase out, which effectively the sunset provision in 2026 will bring it back down to somewhere around $6 million per person with portability. Remember, this is just one of the proposals, and President Biden, when he was running, was using the term $3.5 million is more than enough. And so every proposal is still on the table. I've seen, tax acts where they amended their proposals and then went back and took the original proposals and put them into place. So the decoupling is the next thing that we were worried about. It did not appear in this last Wednesday's presidential release, but they have been talking about stopping the or decoupling the gift and estate tax, thus having different exemptions for each one. They were going to talk about giving us a $1 million gift tax exclusion and having the 3.5 million as the exemption amount. So if you try to use up your lifetime exemption, you would have to pay tax because the gifts would be $2.5 million into the taxable realm. Waiting to see on that. The decoupling is a very realistic option because decoupling guarantees tremendous amount of cash flow to the government, and they need it. Next, eliminating the step-up basis. This one is scary. For those of you who have clients who have received either trust interests or gifts from grandparents, how do we figure out what the basis was in the property? It's almost impossible for very old property still have schedules on basis. And the government is saying that they're willing to give each person $1 million of step up. And that's the, I think you've all heard that when someone dies, their assets get stepped up to fair market value. We've exposed the estate to the highest tax rate in the country, the federal estate tax, and therefore they were going to forego the capital gains. Now they're no longer willing to do that. If this proposal goes through as it has been laid out, it would give each of the spouses $1 million worth of exemption, and then everything else will be treated as if it was a realization event. In other words, death becomes a realization event for income tax purposes. The capital gains would be exempted only as to $1 million to each. So you got a $10 million estate, you're going to have roughly $8 million worth of capital gains paid. Add that to the estate tax, which will still be in effect. Then goes the next part. They're proposing to keep the $500,000 exemption that we have, $250,000 for each spouse on your personal residence. That's the Section 121A exemption. They're going to treat at death as if you sold your half interest in the home, and ultimately the only step up in basis we would have effectively is $2.5 million on a family's estate's assets. That means for very wealthy people, tremendous capital gains and tremendous estate taxes. Now comes the issue of eliminating the 1031 exchange. As you're aware, in 2017, when the Trump plan came into effect, it got rid of almost all the 1031 exchanges that were allowed except real estate. Actually, real estate, for some ungodly reason, turned out to be something that Donald Trump wanted to keep. Now comes the issue with Biden. They are willing to allow $500,000 worth of 1031 exchange to be non-recognized. All the rest of your capital gains would have to be paid at at the time of the exchange. IRC Section 199A, again, another provision that's scheduled to sunset in 2026. There was a lot of talk about us seeing the 199A, which is the lower 20% for service companies, that tax rate. There was a lot of talk about that disappearing. It looks like they're going to let that sunset with the higher estate taxes for now. Next slide. All right. New York State threshold. We all know that there's no exemption for New York State, right? New York State has a threshold and not an exemption. An exemption means if I have a $5 million exemption for federal purposes and a $6 million estate, I pay tax on only $1 million. The threshold says, New York State, if I have a $5 million threshold and I have $6 million in assets, I pay tax on $6 million. Now, we know that if the federal limits drop, New York State has already made it very clear. They are not going to have a higher threshold than the exemption limit for the federal government. So if the federal exemption goes down to 3.5, we have to expect that the New York State threshold will drop below 3.5. And that's where some people we've heard of from Albany are talking about bringing it back to the $1 million number we had effective before April 1st, 2014. New York State, this is a great one. Sports betting and marijuana, they're going to be taxing those things. And here, the tax on marijuana is going to be a rather interesting endeavor for most of us because they're going to look at the potency of the drug, the marijuana, and figure out how to tax it based on potency, sort of like putting a tax on alcohol based on its percentage of alcohol. So effectively, New York State and your 14-year-old kids are going to be looking for the same thing, stronger pot. Now comes the New York State changes in healthcare marketplace in COBRA. This is something that
No, this is just some quick things, and I know Scott Lewis was telling me, and I've read that they've extended, if you're on COBRA, and they're extending some of the benefits, but they've also taken the marketplace and they've allowed for higher earners to get a bigger discount. I'm not 100% in that market, but there are changes just to be aware of for you and your clients.
Right.
Because there could be opportunities to save money or, a lot of the money in the current plans is going into healthcare. So it's just something to keep an eye on. And as things change and as we're helping clients, something to know.
Right. I skipped over the maximum rate for New York State. The estate tax, which is no longer a credit on the federal tax return for New York State estate taxes paid, is going to go up from 16% to 20%, and that will affect any estate over $10 million.
Right. Thank you. So let's talk about some of the planning environment that we have today about with all these changes possibly occurring and some of them definitively occurring. Listen, we know that the state and the federal government have a very aggressive spending plans and they have tremendous debt. So there's a combination. The only way to control debt and spending plans is to raise revenue, which is through taxation. So with that, we know the 2026 sunset is coming on the estate tax. Even if they don't make the changes this year, Larry had mentioned to me in the past when we had some meetings that they could claw back to the beginning of this year. We don't think so, but it's something to plan for just in case. Also, if you have high net worth people right now that haven't done gifting, now you have the chance to do a great deal of gifting, which you may not have that opportunity later. If they cut that down to $1 million, and you want to do some gifting or move some things around, or if you have clients that are heavily involved in real estate and have been 1031 exchanging, what's going to happen to that value of that real estate at death? Are they going to be able to keep those properties, or is it's just going to be taxed so heavily they have to sell them? So these are some of the things to look at. The new administration brings more immediate uncertainty because of those environmental factors. The AFR rates still remain very low. For those that don't know what the federal rates of AFR, that's a loaning rate that you can loan to your trust, and the interest rate you can get back from your trust. So it's part of a planning strategy we use in life insurance that I'm going to go over. So when you're meeting with your clients, you need to ask, have they done any planning with an estate planning attorney before? And I have to tell you, working with Larry, and this is, I'm sorry, but I've worked with Larry for 20 years, and I have to tell you, there's nobody more knowledgeable or who protects you and your clients better than Larry, who includes you in the discussion. And that's what you need, is you want to be included in that discussion from someone in the financial world that needs somebody to run things back and forth. Larry is always willing to help you at no charge. Of course, if he has to set up trusts and whatnot, there's a charge. He doesn't work for free. He's cheap, but not, you know. He's
First off, let's start off
okay.
with the
I won't
payment
go
will
there.
be made as usual. Every time you
Right.
get an endorsement like that, $10.
There you go.
Okay.
But do they have their will set up? Do they have any trust set up? If so, what type of trust do they set up? Do they own life insurance? Is it a life insurance trust? I got to tell you something, and again, one of the biggest malpractice areas for an estate attorney, and Larry was telling me this, is when people set up a life insurance trust because they think they're going to do it, yet they own the life insurance. I've run across 3 of them in the last week. They own multi-million-dollar life insurance policies in their own name. That's included in your estate. Yet they have life insurance trust, but they don't have the trust, the policy inside the trust. No, 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 no. This is why policies and trusts and everything has to be reviewed for your clients.
So
Do your clients have planned gifting strategies? That's a big question. Have they done any? If not, now's the time to talk about it. Do they have charitable gifting strategies? Okay. If they don't, and they're charitably minded, or even if they're not charitably minded, there's some planning opportunities that could say why to give to charities now as opposed to later. And we're going to discuss that real quick. I'm sorry, Larry. Yes.
I was just going to point out that life insurance policies have a look back period. From the time that you give up your ownership in it, it's still considered to be your asset for estate tax purposes. Section 2035 includes it for 3 years.
Right. So did your high net worth clients make gifts last year, or have they funded the trust? Can the trustee optimize trust-owned assets with life insurance? We're going to compare gifting and trusting versus gifted trust, the purchase life insurance, prior to discuss the benefits addition, the tax benefits, federal tax liquidity. And I have to say, with all these taxes coming in, and we're going to point this out later, the most efficient return on anyone's investment today with all these different taxes, if you could come to the conclusion, the one area that's been left behind is life insurance. And sorry, I'm in that business, but I'm very happy I am, because now is when this is the most favorable time to be talking about life insurance, where you can pass on an asset tax-free inside a life insurance trust and estate tax-free. Income tax and estate tax-free. It's the only product, I don't care how good an investment advisor you are, what a ROI, what a return on investment, okay? And that's what I wanted to say. So why do they hesitate to plan? Like we all hesitate to plan. We're waiting for the market to go up before we buy, and then we sell. Oh my God, the market's going down at the worst times. Everybody's sitting on the sidelines, especially with COVID. People didn't know where their businesses were going. Okay, things are opening back up. We need to sit down and say, hey guys, let's figure this out. We need to make them aware of their tax structure. The stretch IRA. Now, it's a, there is some limited stretch IRA provisions. Sorry, I know, Larry, you're going to correct me, but at the end of the day, what the IRS did with the CARES Act last year, at the beginning of the year prior to COVID, is they restricted on most distributions at death, your IRA money, to 10-year payout. And that can be very detrimental because this is pre-tax money. So over the next 10 years, if you're a 20 or 30-year-old or 4-year-old inherits that, they got to take that money in 10 years. Okay. So they got to pay taxes the next 10 years. Now, the IRS wants their money. We've given you a favor, we want it back. That's the whole idea that increased estate and income tax. We all see it, we all hear it, we know what's coming. Gifting limits could be restricted. Cost of waiting. Products are changing rapidly, insurance products, rapidly. The product may not be around next year. The one you want to, the long-term care you wanted to buy today may not be there next year. Okay, that's number one. The life insurance products are changing dramatically. Guarantee ULs have left the market. There's 2 or 3 left. One of them just announced a price increase for May 15th. There's reasons for that. What's the age and your health of your client going to look like 6 months from now, a year from now, or if they get COVID and they're in the hospital and they can't get insurance anymore? You have to plan while you're healthy, okay? How much will the price change over time? These are all unknowns. This is why you got to bring them back to the table today and say, hey, we got a plan. Listen, everybody's running and doing their income taxes, and we all get caught up in the day-to-day moments of life. But you know what? Now's the time to plan. That's the message of the day. So ideas. If you're doing life insurance, you could do a planned gifting strategy. Establish the wills and the trust now. Set it up. Okay. Fund it with life insurance. Very tax efficient. Okay. How do you fund it? Well, you can leverage this low interest rate environment in 2 different ways. One's a wait and see, which is an alternative to gifting. And how is that alternative to gifting? I can loan my trust $1 million. Okay. And that's kind of like a wait and see thing. Fund a life insurance contract, have the trust pay me an interest, the AFR rate. It's one unique way of doing it. The other way, so what's my access and willingness to make a gift? Maybe I don't want to make an irrevocable gift today. Maybe I don't want to throw this all into a trust and not see my money again. That's why you would do it. Does the client already make gifts? Have they used their lifetime extension? Do they have existing trusts? So these are things. If gifting is an option, leverage low interest rates. One of the things I talk a lot about, you've seen seminars on, well, let me just show you what the FR rates are. The FR rates are stupid low right now, okay? Now, they're higher than they've been earlier this year, but they were as low as 1% and 2%. So loaning them money from the trust is not gonna kill the thing. So that's the whole wait and see thing.
As well as if you want to help if grandparents want to help their grandchildren without making gifts, they can pay for a mortgage. Basically help them buy the house with a 0.6 or 0.7 rate on the mortgage.
Okay, I'm not going to kill you guys on time because of time, but I'm going to give you a copy of the presentation. But this is a whole thing on how this whole wait and see strategy goes on, and how you can repay the loan or forgive the loan, all in that kind of strategy. I'm sorry, I'm jumping pages here. How'd that happen? The other area, and my slides got a little messed up. I don't know what happened. There we go.
There we go.
Premium financing strategy. The way we do premium financing is we establish an irrevocable life insurance trust. The ILIT borrows the money, not personally. So it doesn't affect their personal credit, the way we structure them. Okay, very important fact. Third party finances the policy. The client pays interest to the trust. So if you have a client who needs a lot of insurance, 10 million, 20 million, $30 million, this is how we set this up. The only gifting that's done is the interest paying to the trust. So you're not gifting that money. You're borrowing the money. So if you have gifting limitations, but you have a big need to protect your estate, this could never be a stronger strategy. And of course, the borrowing rates are very low. And the fact now that they've changed it with Section 7702, you can dump in a lot of money and hide it. And you could do it with the bank's money and just pay interest. And then we can go through, you know, how that all works, but very strong strategy. All right, I messed up my pages here, but moving from estate planning and talk about general planning with clients, and you talk about 401k planning and IRA planning and investment planning, understand the long-term nature of all the different investments that are going on right now. IRAs, Roth IRAs, they're estate taxable. You can still invest money in life insurance, grow the money on a tax-deferred growth, take out the money tax-free, unlimited and flexible contributions, no penalties for access to cash, and a tax-free death benefit. And if you put it inside a life insurance trust, estate and federal income tax-free.
And possibly even generation skipping tax-free.
If you're talking about retirement, and we talk about long-term care quite a bit, we talk about longevity, let's talk about sequence of return risk, withdrawal rate risk, and taxes. Okay, if you're somebody who's done very well and has followed all your accountant's advice and put millions of dollars into your 401k or IRA, and you're now at retirement, one of the worst things that could possibly happen to you, okay, is one, you get dementia, and two, you have a market drop, which inevitably the market goes up and it goes down. The problem is in retirement, when that market drops, okay, although you've experienced all these gains over these years and all of a sudden you have a drop and you don't know what you're doing and you're not covering long-term care, how are you going to last? Okay, the sequence of return risk is huge. This is why you need life insurance as a backstop to all the other things that you're doing. I'm not saying it's bad, but it needs to be a backdrop. And with people that retire, okay, and are in retirement, you need to develop a spending plan. Okay, how am I going to develop a plan to have income that I can't outlive? Okay, and not have to worry that the stock market tomorrow is going to crash. These are things you have to think about, and it's why you have to integrate different products and strategies in your planning. So with that, I'm going to have Larry kind of sum up what's going on in the market, and we're going to leave room for questions.
Okay,
Go ahead.
let's start off with, that's where all the taxes are going. They're all going up. We have interesting things happening for individuals. Their income taxes should be going up for anyone who has more than $400,000 worth of income. They're going to see the old 39.6% rate, which had been dropped in 2017 to 37. That's going to come back. They're also going to have a gap, and it's a weird thing, up to $137,000 of Social Security income is going to be taxed, and you'll pay on it. Then there's a gap until 400, and they're starting to say that they want to put Social Security SSE, self-employment tax, on those people over $400,000 of income. We also have the magic number 1 million. If you have $1 million of income, you're going to end up with a issue of potentially, and this is all depending on the latest of the Biden plans, seeing that all your capital gains will be taxed at ordinary income rates. So we have, again, one of those up in the air, but most likely going to pass. Then we have the issue of, I get deductions, right? There's a standard deduction, and I can take my Schedule A deductions. Schedule A deductions will be limited to never, basically it's creating an alternate minimum tax, because you'll never have a tax rate of less than 28% using the Schedule A adjustments if the latest plan is put into effect. So all we can count on is taxes going up, our estate planning options dropping significantly. Another one of the issues that was floated is every 10 years in a grantor trust, make it a realization event. If that were to happen, you're going to pay capital gains every 10 years on grantor trusts. Horrible, horrible tax planning backdrop there. And so the more we look at it, the more we see that insurance properly funded is going to be probably the premier estate planning technique coming into the 2022 and forward, and at least until they change the laws again. So for the insurance industry, this is going to be a beautifully, beautifully aggressive year for selling products that people need.
Great, thank you. Now I want to get to questions. I know Donnie had mentioned all these things are subject for negotiation. So all these tax changes have not been put in place. And of course, the Democratic administration right now is being very aggressive in their spending plans and how they're going to pay for it. And one has to come with the other. You can't keep going further and further into the abyss of the debt that we're in without covering it. So yes, it's all going to be under negotiations, and we expect it'll probably meet in the middle in a lot of these areas. So that's kind of what we're looking at.
To add to that, you have certain senators like Senator Manchin who come from areas that have very high net worth people. They're pushing back against these taxes. They're not on board with the natural democratic tendency at this point to tax. They're trying to hold it back. So there will be negotiation because of that. Somehow they have to sell those holdbacks on these plans. So we can't expect everything to go through. There are some things that will go through, and we suspect the capital gains over $1 million is going to become an absolute. I don't think they're going to negotiate on that. So,
one more question to add, I guess, as part of that.
sure.
I know that for the New York senators, they said unless they repeal SALT, nothing's happening. This is not going to go through because they won't get the New York support, and obviously -2 senators, they just can't pass it. Have you heard anything about the SALT deductions getting the cap being removed, or is that everything is kind of been jumbled up together that SALT is so far out of the conversation, no one's even paying attention to it?
Yeah, it was a big surprise last week when the new plan did not mention the repeal of SALT, right? The SALT limitations. I agree with you that it's a major omission, and I suspect that it's behind the scenes. It's definitely going to be repealed. I just don't see them being able to get New Jersey, New York, and a couple of the other blue states that are big tax states being able to sign on to a plan that doesn't give them that for their constituents.
Dennis had a question about gifting a farm.
Oh, boy.
If you gift a farm that increase in value from $1 million to $5 million, what would the tax be? Parent to children transfer.
Okay, so there is a section, oh God, it's a 2032A. There's a paragraph, a particular thing that says that for the family farm, you can have a special treatment, special use valuation, and they value the farms at their farm value as opposed to the highest and best use. There's nothing that I've seen in the act or any of the proposals. I mean, the act being the last proposal, any of the prior proposals that deal with family farm exclusion. So for now, I think that you have the special use valuation continues. I'm just not sure if you're going to have a special exemption to avoid the capital gains. It would seem natural to tie it in. Can't guarantee anything. It's all on the table at this point.
And one of the things I touched on, but I didn't go into detail on that, I just want to cover a little bit because now that we have a few minutes. One of the things, planning strategies that we used many years in the past, and we've talked about in previous meetings, called a charitable remainder trust. And for those of you who don't know, if you have a highly valued property or stock portfolio where you're anticipating extremely large capital gains, the way a charitable trust works is you can set up a trust, you can have a charity basically sell that and pay no capital gains. Now, the money remains in that trust for the benefit of the charity of your choosing, okay? A small portion of it. But that money can be invested and/or it could be annuitized, where you can have an immediate annuity with the money coming back with a small charitable deduction of income. And then if you want to replace that asset, estate and tax-free, you buy a wealth replacement trust, otherwise known as life insurance inside a life insurance trust, and you can pass that entire asset estate tax free, and if you do it right, have an income besides. So if you have real estate investors that have been swapping and dropping, swap till you drop, swap till you drop, swapping 1031s. I know a lot of investment guys, this has been their strategy. But at the end of the game, IRS wants their money and they want it now and quickly. So this is a great, great strategy that can be used in planning. And it's a charitable remainder trust. There's charitable LLCs. So all kinds of little things that people can do. But this is why you want to bring these topics up now, is now's the time to plan. So if that's the thing, or people are looking to stretch their IRAs out and now they can't, you really got to talk to these people about, is this really the best tax diversification strategy for you to be having all this money sitting in your IRA as retirement and may not even use it? Is this the best strategy? So
Neil,
today, you really have to alter the mindset of people that have been saving and squirreling away all this money and don't realize the implications and the tax consequences that they're about to encounter.
Neil, one more way to tie together IRAs, charitable remainder trusts, and life insurance. If you have a beneficiary who's relatively young, but at least 28, who is likely to need distributions, who probably won't have a taxable estate, and is at low risk of creditors and spouses, you could leave your IRA to that person in a charitable remainder trust. And the fact that 10% of the value goes to charity is offset, more often more than offset, by the ability to replicate the stretch. And then if that child or grandchild has people dependent upon him or her, the family could buy life insurance on that person's life to protect against the risk that that person dies early, and more value went to charity than you expected.
Absolutely.
That works.
It works. I wrote an article on it in the April 2020 issue of Trust and Estates. If you search for it online, you should be able to
Terrific.
find it.
Excellent. Any other questions?
We're early.
Okay. We have 15 minutes. If you guys want to stay on, we can do a little networking and people can introduce themselves as to what they do. If you have to leave, you can leave, but if you want to stay on, we can kind of introduce who we are, and we can start with you, Bruce. What is it that you do?
Well, I do tax, wills, trusts and estates. Speak and write on those things quite a bit.
Terrific. Well, thank you. And Larry Bloom?
Hey, good morning, everybody. Larry Bloom with Bloom Schoen CPAs. We are advisors to privately controlled companies, primarily small business, a handful of middle market companies.
Terrific. And John Malcolm?
Hey, good morning, everybody. Neil. John Melkin. I am a financial advisor with Forest Hills Financial Group. I do financial planning for individuals and businesses.
Terrific. Phil?
Hi, good morning, everyone. Phil Kennett, partner over at Nussbaum. I'm a forensic accountant and business appraiser. I do a lot of valuation for trust and estates and a variety of other litigation or non-litigation matters. Nice to see everyone today.
Terrific. Thank you. How about you, Scott?
Scott Lewis. Aside from doing insurance that everybody else out in the world seems to be doing, life and disability and long-term care, I'm an employee benefits specialist. What's different about what I do in employee benefits, aside from the large groups that everybody always wants, is I can work with individuals, single person, as long as they're employed and fairly healthy. I can get them really good plans. I also help navigate the very complicated quagmire of Medicare. So when people have questions, I'm here to answer them and help them make some good decisions in their own best interests.
Terrific. Susan, how about you?
Just had to unmute there. Hi, I'm a CFP focusing primarily on life insurance strategies.
Terrific. Dennis?
I'm an Aflac agent. First, I've heard Scott presenting before. I highly recommend people consider Scott for what he's selling. And you know, Aflac's the duck. Supplemental medical insurance on top of your existing medical plans. I just collected $2,000 this month on mine. It's good stuff to have. Really cheap. Nice way for small employers to throw a little benefit of their employees to look good. It doesn't cost them that much money.
David?
David Rothfield, I'm a CPA. I also am a financial planner with American Portfolios. Hopefully today I'm finally going to sit down with that client with those two policies for you.
Excellent. Tim, baby.
He's promised too many times, and we'll see if he shows up today.
There you go. Tim.
Hey, good morning, Tim Kennedy. So we talked a lot about retirement today and life insurance. I'm a certified reverse mortgage professional, educating professionals like yourselves in the benefits of a reverse mortgage as a tax-efficient retirement income tool, touching on all the aspects of longevity, liquidity, lifestyle, legacy, and long-term care. So if you have any questions or concerns or want to learn more about reverse mortgages, give me a call. Thank you. Thanks, Neil. Larry.
Tommy G.
Good morning, everyone. Thank you, Neil and Larry, for today's talk, and everyone. My name's Tom Granata, as you could see from the screen. I work for American National Insurance Company, and we're a manufacturer of life insurance, annuities, and we have a full turnkey pension platform and department that you could tap into. And I think these talks and these what Neil and Larry are doing and today are important. And for me, it's good to get a pulse. I call it getting a pulse of the people. You know, what are people talking about? What are the issues shaping our industry? And these are important. So thanks for this, and we'll keep talking, I'm sure.
And Tom's been a valued partner on the wholesaling end to Main Street Planning Group for many years, even prior to his current job. I'd say we go three jobs back. So I don't know why my thing is not on. And Kim, can we see you today? Or are you in hiding?
Oh yeah, I'm sorry. Yeah, I am in hiding. I apologize for that.
That's okay.
So I'm Kim Taylor. Thank you for inviting me to this seminar today. It was wonderful and very informative. My company is Settlement Funding Associates, and we do tax-exempt structured settlements through personal injury, medical malpractice, and workers' compensation claims. We work nationwide.
And Kim's good at what she does. If anybody needs to meet Kim, I'm happy to make an introduction.
Thank you.
Thank you. Jeffrey, are you there? No. Mark Mingle, are you there or not there? Well, anyhow, glad to meet everybody and hope you can join LIAFPN. Again, I'm promoting membership. It helps pay for all our events. We are going to look at doing some live events and cocktail parties again. Woohoo! You know, and we're going to continue this format because we find that we can reach a lot of people and on a consistent basis. And I guess that's one of the positives of this crazy pandemic that we've dealt with, is that we've gotten to meet a lot of people that we may not have met, you know, because we can't all go out and have cocktails. So
not only that, Neil, like if we have meetings, it's just so much easier to jump on here than it is to try to get together at Bethpage and then Zoom somewhere else and drive. This makes my life much easier.
Good. Terrific.
Okay.
Thank you.
Before we go, just a little bit of housekeeping.
Yep.
There's a lot of members out there, and some of you have interest in hearing about different topics or have a specialty area that you'd like to present. Please contact Neil or myself, and we can see about making one of our Wednesday meetings into a presentation that you've suggested.
Right, and we're talking later today with a firm that does accounting for cannabis dealers and people. So we think that they may be an upcoming speaker. We have a lot of things on the slate, but always willing to listen and add more value to the group. So
Hey Neil, Larry, I think one of the first in-person meetings that you should do is get one of these cannabis places to do like a test tasting for everybody.
there you go.
There you go. Combine a hookah lounge with networking. Okay.
You get a great turnout, I promise.
I believe you. I'm going to Denver in 12 days, so they have those there.
They do.
Yeah. Yeah, they have whole restaurants that you can different, but I've never been, but you know, my
You
son
can
does.
describe the furniture though.
What?
I said, you say you've never been there, but you can describe the furniture.
Yes.
Okay. All right.
All right, listen, have a terrific day, everybody. Any questions? We'll leave you, Larry, my information. And again, thanks again for coming.
Thank
Thank
you.
you.
Thanks all.
Have a great day.
Good
Good
to see
day,
you,
everyone.
Dennis. You too, Tim. Bye, guys.
Thanks, Neil, Larry. Great job.
Have a great
Good
day,
job,
all.
guys. Take care.
Thanks, guys.